This $0 tax number probably looks beautiful to you, but to me, I am cringing at the missed opportunity. When you retire, you might have a few years where your taxable income is super low and you pay zero tax because you're living on cash savings or living off of investments from a taxable brokerage account. The 0% tax bracket is everyone's favorite, but there is a wrong way to do it, and you may not be taking full advantage of it. Hi everyone, I'm Scott, a CPA and financial planner, and I recently met with a retired engineer, and he'd been retired for 2 years, and he was talking to me because him and his wife just wanted to make sure that they weren't missing anything. He'd always handled their investments, filed their returns, and he was pretty confident that he was doing things right, but he doesn't know what he doesn't know. So we're going to look at their situation and the opportunity that he was missing and was on track to cost them thousands of dollars each year in missed opportunity. And at the end, I'll tell you what those thousands of dollars meant to them. All right, so let's talk about his plan. And let's assume that they're in their early 60s at this time. His plan was to use taxable investments as long as he could before dipping into their pre-tax retirement accounts, 401ks, IRAs, and hopefully they could do that until they started Social Security at age 70 and RMDs, required minimum distributions, kick in their early 70s. So let's assume that they live in an income tax-free state just to make this analysis easier so we only have to worry about federal. And they also have some sort of retiree health insurance. I don't want this video to get into premium tax credits, but if you do think you'll be getting health insurance through the exchange in retirement, I have a video about how you might analyze for that. Now, he was super proud of the fact that their only income was a little bit of interest and capital gains each year from the small amount that they would sell off to live on. So he projected that they wouldn't need to touch their pre-tax retirement accounts, 401ks and IRAs, until those RMDs kicked in. So looking at a previous year's tax return, it might have looked something like this. Now, this obviously isn't it. This is me doing a case study, but $0 in tax. What could be wrong with that? Well, quite a bit, because he missed an opportunity. And what we have to look at is this right here, this standard deduction. That is the missed opportunity. Since capital gains are taxed at their own rate and ordinary income is taxed at the more talked about tax rates of 10, 12, 22, these numbers aren't super clean on this tax return. But basically, they need to fill this $27,000 standard deduction with ordinary income. So how much ordinary income do they actually have? Well, in their case, it's just this taxable interest. The qualified dividends, the capital gain, that is not ordinary income. So boom, there is an opportunity right there. So what they could be doing is taking a tax-free distribution. So what we did, we added $20,000 of an IRA distribution, which caused their taxable income to go up. But what happened to their taxes? Still zero. Still that magic number. So now, not only did they pay zero taxes, but they got $20,000 out of their pre-tax retirement account at a 0% tax rate, which means that $20,000 never got taxed. They put it in and they got a tax break the year they put it into their 401k, let's say. Then let's say it grew inside of their 401k and they were never taxed on the growth in the dividends because it was inside that retirement account wrapper. And now they're withdrawing it tax-free in retirement. Now remember, their plan was to wait until their 70s to start required distributions and start Social Security. Well, what if they were able to get $20,000 every year between now and then taxed at 0%? And let's say that that's 10 years. $20,000 for 10 years, easy math, that's $200,000 of income totally tax-free. And let's say their effective tax rate on that money would have been 12% once they got into their 70s. That is $24,000 in saved taxes. Is $24,000 life-changing? Well, kind of, and I'll explain that in a second. But what this illustrated is, what else are they missing? And to be honest, this is just the start of a strategy, because now I have more questions. Should they be doing Roth conversions instead of distributions from the IRA? Should they be filling up the 10% ordinary bracket, or even the 12% ordinary bracket, since we project that they'll be in the 15% bracket in their 70s? And are they taking advantage of capital gains and loss planning? Should they be harvesting more gains? But what I know is that in this case, they were wasting the 0% tax bracket opportunity that was right in front of them. Now, my favorite part of this story is that when I explained this exact thing to them, he wasn't all that overly impressed. He was like, oh, okay, yeah, $24,000 over the next 10 years. Great. But what the wife chimed in and said was that, hey, when we retired, we decided to stop having a house cleaner come once a month to do all that deep cleaning that we hate to do. And guess what they had been paying for that? About $200 a month. So is $24,000 life-changing? No. But for them, it was 10 years of not having to deep clean their house. So if you want to see a more in-depth case study of tax planning in retirement, check out this video where I go into much more detail and tackle a few different questions that we didn't get into in this video. Now, if you enjoyed this and want more like it, do me a huge favor and subscribe. Better yet, go watch one of my other videos to decide if you want to subscribe. Till next time, have a great day.